I'm joined by Matt Henrik, Senior Vice President, National Sales at Sprott Asset Management. How are you doing, Matt?
I'm doing very well, John. How are you today?
Okay, and then you're getting ready with your gang for Halloween, I would guess.
Yeah, a birthday party this weekend and then Halloween tomorrow, so busy times.
Well, let's try and figure out what's going on in these markets. We've got some major change taking place. It looks like fixed income, that is interest rates, are moving up in spite of the Fed not raising rates yet. And that's not just U.S. Treasuries, but it's also the German 10-year Bund, which is a very important rate for European markets. And then equity markets were down on the week, and we had a scare on Friday because the head of the FBI is relaunching the probe into the Clinton emails, and that has created some more uncertainty ahead of the election. And I wanted to go over good defense because given everything that's going on, that has to be the focus of a portfolio. So I thought I'd start with the fixed income strategy, which is proactive at Sprott Asset Management, and you might just give us a snapshot of that.
Sure, John. Definitely rates have been and will continue to be an issue, and we are very well positioned at Sprott. There are tens of billions of dollars in Canada in what we call these long-only, long-duration bond funds, which are about to get creamed. It's like the Titanic heading for the iceberg. The average duration is 7 and 8 years because the managers have had to go out that far just to squeeze 1.5% for the unit holders. And now the capital gains are all out of these bonds. As I say, the positions are so big that it's not as if the fund manager can change the position 5% without causing a shift in the bond market. So I fear for everyone out there that has what we call a long-only, long-duration bond fund. And again, the numbers, I want to say $300 billion in Canada is sitting in this money. At Sprott, again, Scott Colburn, we've got global unconstrained mandate, meaning he can go long, short, he's tactical, and we have an unbelievable suite of alternative income products which have been doing nothing but adding great value to our unit holders. So if you are in these bond funds, I highly suggest you talk to your advisor. It's time to get out.
Now, you had John Wilson, who manages the enhanced strategy here in Ottawa during the past week, and I think it's important to relay the message because it is very defensive, and a lot of people are trying to knock the ball out of the park, and John plays singles and doubles, and when we get a market event, his strategy is a strong one. And so if you could give us some of his comments.
John runs a mutual fund portfolio, but it's considered to be a hedge strategy because he's got a level of protection in there. And to be quite honest, in the last 18 months, globally, the sort of quote-unquote hedge fund managers have been taking it on the chin because it's been so impossible to manage money when there's been massive sector rotation, there's ETFs, high-frequency trading, central banks coming out and basically the market's trading on what central bankers are saying. So these traditional hedge fund guys have been underperforming in the last 12 to 18 months. And John certainly has felt some pain. But the long story short is, again, we're at market tops here. We've got a U.S. election. We've got so much uncertainty. I believe we're going to have a 25 basis point rate hike in December. There's really no way the Fed can back out of that. So you certainly want to have a fund manager that has exposure to the markets if things are good. But more importantly, if things turn sideways on a dime, and they certainly can in this business, 1987 is a huge example of that. You want to have somebody that has got defense on the field, and the enhanced equity strategy certainly does that.
Now, Matt, let's talk about the Nortel factor.
Yeah, sure, John. So Nortel has been in the news again recently. There's thousands of Nortel pensioners and former Nortel employees in Ottawa that have recently received packages giving them to the end of the year to choose between how they want to deal with their pension assets. One, basically get a non-indexed annuity monthly payment, and two, get a lump sum rolled into a life income fund. And if they do that, their money will be leaving Nortel, and they'll be having to find an advisor to look after that for them. Now, I've been dealing for the last 7 or 8 years with a very experienced team here in Ottawa called Ayer Financial, and I've gotten to know them very well. And they have put together a really good white paper and a questionnaire on this subject. And I highly recommend that if anyone out there is listening and has this choice, you go to nortelchoices.ca That's nortelchoices, all one word, .ca, or you can simply call them at 613-569-7020, 7020. And you can register, fill out, and read the white paper. And they're planning on doing 2 or 3 seminars in November to basically to help folks identify what the best decision is for them. And again, it's free, and it's the value add, in my opinion, is tremendous.
And Matt, for listeners and advisors who would like to get in touch with you directly, give us your coordinates.
Sure, John. I'm always reachable toll-free at 866-299-9906, and always available at sprott.com.
And good luck with Halloween, and we'll talk again next Sunday.
Well, let's hope the markets don't spook us too much this week, John.
Stay with us, folks. After the break, Kevin O'Leary, who's chairman at O'Leary Financial Group, and he discusses the implications behind the FBI's decision on Friday to reopen the Clinton email probe.